This week we're going to start with CPI and the market killer PPI. CPI did come in higher than expected, or, well, not higher than expected, but there's been an upward trend in CPI, 2.7 for headline. And for core, 3.1. We got a 3 handle on that. It's a lot more comfortable to have a 2 handle on that going into a Fed meeting in September. But I'm going to give you 2 good, solid reasons why I think a cut in September is pretty much a done deal. I wouldn't go with 2. I think the rest of the committee would be willing to go along if it was 1. The dot plot will be more exciting. But here's the thing that the rate is hiding, 3.1. We think, oh my God, it's going back up. Let's look at base effects. This is 2024. This is 2025. And you can see May of last year was 0.0396 versus this year 0.0809. June was slightly negative. Here was positive 0.28. Call that, they round that to 0.3, they round that to 0.2. This is month over month, 0.1389 for 0.1966. So I'm going to draw a chart of the index, not of the CPI, not the percentages, but if you start the year here in 2024 at the index level, what you had was a shape that looked like this into the end of the year. And that then becomes the starting index for 2025. Now I'm going to draw a line that is consistent with 2%. And we will just ignore the numbers we saw this year. I just want to show you something with the base effect. So let's say I draw a line here that's consistent with 2%. So if we measured this, we would have 2% year over year. Well, you have inflation each month decreasing. And you think that's the right trend. It is decreasing. And then you have inflation month over month increasing. But this line is consistent with 2%. It didn't budge from 2%. This is your base effect over here. If you have a period last year over year, where you have higher readings this year, but you had low readings last year, it will give the impression that CPI is growing at a very fast rate because you're not isolating the base effect. So what I did is I controlled for the base effect in both headline and core. If you control for the base effects year over year, headline came in at 2.33%, not the 2.7% headline number. So here we're just taking out the effect of the base and looking at just the actual price change year over year. 2.33 is 2.7. And if we do it with the core, the base effect brings us to 2.78 versus 3.1, so we are not printing a 3 handle on this. This is the statement Powell had made, I think about 3 meetings ago, when inflation, the CPI and PCE were both coming down. He did say the committee is expecting it to go back up over the next few months as we work off the base effects from last year. So they were expecting this. They did mention it, so they are aware of the base effect. I'm sure they will control for the base effect, and the numbers that they're probably paying attention to are the 233 and the 278. Now this is just adjusting for, because it's August, we only got the July numbers. It's only adjusting for July to get a trend for the year to determine if the adjusted index is increasing month over month. I would have to adjust for the base years, which means in the early part of the year, when we saw CPI decrease year over year, I would have to adjust for that. Maybe at that point we would have seen it increase year over year. But I just did it for July just to show that the numbers that we're seeing has within it both a price effect and a base effect, because we are taking the year over year. Overall, CPI isn't really worrying. PCE usually comes in lower than CPI, but PPI, there is no defending that. Let's look at that. Okay, let's look at PPI. I've got all these series up here. We have final demand for goods, final demand for services. Here is processed goods for intermediate demand, and this is unprocessed goods for intermediate demand. So you can think of this copper coming in would be an unprocessed good. Copper rods coming in would be a processed good for intermediate use. Trump is tariffing the intermediate copper products, but not the raw copper itself, which, again, if you've listened to me before, that would have been just a stupid tariff. Let's look at these numbers. Let's start with final demand. What is this? If you have CPI, which is the consumer goes to the business counter. There's a guy standing beside the business counter saying, give me this money. And whatever money this consumer gives, and this is with any sales tax in, becomes part of the CPI. The producer does not receive the tax, so it's only the money that is paid, but other entities show up at his counter. Insurance, government, etc. They show up here. Well, then it's whatever they receive from whatever demand there was. So it captures a broader range. And of course, it is without the tax. If it is sales tax, if it's an import tax, it was already in the series over here. So it's already in the price. What's in the price? Let's have a look. If we look at total final demand, 0.9. If you look at the series that we have, this is a 12-month high. We look at final demand, less food, energy, and trade, 0.6. We're at a 12-month high. Let's break down final demand for goods and final demand for services. The total is the same as it was in January, 0.7. We saw 0.7 in January. They're both the highest numbers because nothing is higher in the last 12 months, but it's not a 12-month high. We look at final demand goods. February was higher. This came in at 1.4. We had a higher reading in February. And energy, the same as last month. So less food and energy, 0.4, 12-month high. So the combination of these with the 12-month high gives both series 12-month high here. Final demand for services, we have a 12-month high for the total. Trade, which is margins, we will have a 12-month high. This is companies increasing their price, also increasing their margin, and this is still paid by the consumer. So this is it's if you're an investor, it's a nice number to see. If you're interested in lower rates of justification, it's really not a nice number to see. Transportation, also not a 12-month high here. We saw that a much higher number in December. And other categories, 0.7 is a 12-month high as well. Change in final demand from 12 months ago. February was higher than it was now. And change in final demand, less food, energy, and trade from 12 months ago. It is the same as it was in April. So as far as final demand for goods and services, even though the headline came in, less food and energy came in at 0.6, which is a very high number, overall, we have some readings showing that, well, it was the same as just a few months ago. The processed goods, the total 12-month high, the total change from 12 months ago, here is a 12-month high again, 2.1. This is just for the month over here. This is year over year, 2.1. Unprocessed goods for intermediate demand, non-food materials, less energy. That's the materials, less food and energy, 2%, also at a 12-month high. And you can see that these are not, they equal or are less than some readings that we've already had in 2025. So what does all this mean? Does this, usually we think that, well, this will start to flow through because these are intermediate goods. It goes into final goods, which then gets sold, and it'll show up in this series in final demand. This will show up over here, not over here. So had we seen most of the weight on the goods and nothing on the services, we would have said, well, that is a very clear footprint for the tariff. What we're seeing over here with some of these series at 12-month highs, I would say that is a tariff footprint. That it would come out of nowhere for a particular month, the month that all the other, for July, we had a total clean month on the 10% tariffs. that is kicking in. This is consistent with some of the companies that we've heard reporting. Deere, we'll take a look at, in Q2 had 100 million of tariff hit. Then it increased to 200 million because the tariff only started partway through the quarter. And they anticipate with the increased tariffs now in place that they're going to hit 300 million in the fourth quarter. 300 million. So that is all in. So we know companies are facing tariffs. They're seeing the hit from tariffs. They're reporting to their shareholders saying, look, this is, our EPS is lower year over year because of the tariffs. This is the amount of the tariff that they cannot pass along, that they're just absorbing, which is, say it with me now, a tax on corporations. So the big bill lowered taxes, and let's just raise it back up. It seems it would have been more efficient to just not lower the corporate tax rate to the low level that they did, and then you wouldn't have to do any of this tariff stuff. So I think the split of a third from Besant says, if you're looking at the tariffs and who's absorbing the tariffs, he says a third makes sense. Your businesses are in here. This is input costs for businesses, so there's the third. And then the other third is going to show up over here, which is the consumers. But if we think about the 10% plus the new tariffs, and let's assume the Court of Appeals does not overturn this, I think it does. But let's assume that it doesn't, and these are the tariffs going forward. Next month, when you order your items in, it will be the same bill as this month. This month had the tariffs, next month will have the tariffs, so the month over month will disappear. The tariffs really are a one-time hit. It's an ongoing revenue generator because there'll be that tax coming in all the time, but it won't increase every month by the tariff, just once to reset the price. This 1/3 over here is the exporter in the other country that is assumed to be absorbing it. And that may sound neat, is that, well, that's why you don't raise the corporate tax rate, because Americans would be paying 100% of the tax. Yes, Americans are going to have to pay that debt. You're going to have to raise taxes, but why not try to get foreigners to pay some of the tax? And there's a third. Are they really paying the tax, though? Now, I want you to think about it as, let's assume they are absorbing the 1/3. Is it a fair trade-off? The execution of all this has been absolutely terrible. Just in Canada alone, there's $1 billion per year of alcohol not flowing north. It is a general boycott against American liquor products. The cross-border from Canada to the U.S. is down some 24%, representing somewhere between $4.5 and $5 billion that's not entering the U.S. economy. So we're over $5 billion, and I just said cross-border shopping and alcohol. We haven't got to any of the reciprocal tariffs yet that we would expect. Well, a third would be absorbed by an American company. And the other countries that also, to some degree, are boycotting some of the American products. Not only that, Trump, the master negotiator, has done one thing, which is to open negotiations among other countries ex the U.S. Countries that usually had no reason to talk to each other are now talking to each other. Canada is now investing in trade that is going to go east to west, not north to south. We went north to south because, well, it's right there. It's efficient to go north to south. Canada's a big, wide country. It's less of a distance to go north to south. And Americans thought the same thing. It's cheaper to go north to south. Now we're going to go east to west. Here's the catch on this one. Once you start going east to west, that is forever. So if you want to know the hit, the true hit to trade from this, it is the net present value of all the future trade that will be done east to west and not north to south. That's a forever move. You don't build infrastructure and then say, forget it. once that pipeline is built to Quebec, we don't need to send our discounted oil to U.S. refineries so that they can capture the margin. We can send it to Quebec and we can capture the margin, which means we don't need to import more expensive gas from the U.S. We'll just produce our own. That's just one country example, right? So even though it is raising revenue, how much is lost in other places? My estimate is the net effect is negative. We are seeing companies saying, look, we're paying this stuff. And if you listen to consumers are saying that their prices are higher, even though maybe CPI isn't really capturing that story, or PCE isn't capturing that story. So they're paying for it. But as far as other countries paying for it, I don't know on net who is suffering the most. I would suggest that the third that you're trying to get other countries to pay for is more than offset with the negative sentiment around the world. So we're not going to know what this number looks like until September, when we get the PPI in September. However, this reflects July. August, we had a whole new round of tariffs come in. So I imagine August is not going to look good either. This is the other side of the Fed story. When they sit down, they're probably going to get another CPI read, which is going to show the hike in the August tariffs. And I don't know if they're going to get PPI in time. Because they meet the week of options expiration. I think the Tuesday is CPI that week. And if Wednesday is PPI, they'll know the two numbers going into the meeting. And if there is the secondary effect of, I think this is the 10% effect, you have all of these incremental effects. If there's another effect of this, I think that's why when we look at the probabilities for September, they actually dropped from 90% to 84% for a cut. There's a 15% holdback of saying maybe the Fed won't see this as transitory, or will, based on the character of the committee so far, take a path showing an abundance of caution. Monetary policy is in a good place, the usual things. And you're going to put this joker, Mirren, on the committee, and you think that we're going to bend to his will? They might just take a psychological stance on this and say, we have enough evidence to not cut at this point. So there is probably a small probability of that. 50, I don't see any probability of a 50 basis point cut at all. Now, when we talk about Jackson Hole and the topic on Jackson Hole, maybe there might be something there. Okay, on this screen is usually just an informative screen where rates, where yields, what's going on next week. But I think we got two really important things to talk about here. Let's have a look at our money market rates, all well behaved. The 1 year is at 3.93 versus a 4.33 effective federal funds rate. That is 40 basis points lower than the effective federal funds rate, but it's for 1 year. So there's meetings throughout the year. So this represents, this 40, sort of an average of the rates that we'd expect to see this year. So you can double that to about 80. That's call it 75 basis points instead of 80. 1 year looks like it's pricing in 3 cuts at 3.93, and the 2 year looks like it's going a little bit further on an average at 4, pricing in 4 cuts, which I think is not aggressive enough. The long end of the curve I don't think is being aggressive enough on the lower end side. I would look with new Fed chair coming in and perhaps being on the administration side, being on the same page, being on Bessent's page, probably a desire to get that under 4%, which is going to be really nice for housing, really nice for mortgage REITs. So we'll talk about that on the next screen. We got a small bear steepener on the long end of the curve. September 17th, FOMC, and we also get the summary of economic projections where they give us their dot plot, where we think the rate will end here. Some will say here, some here, some will say here. Stephen Mirren will be way down here. You expect to see one dot that is excessively way out there, to really pull it down here. His dot, I'm pretty sure, will be bloody obvious. We had almost 90%. We're down to 85%. We've lost 5% over here, and you can blame PPI for that, and that was July with the 10%. Don't expect any relief from August. August is going to show all of those incremental tariffs on top of the 10%. So 15% that nothing will happen. If I had to put a 50 basis point in there, I'd be saying there'd be 0 on 50, and so is the CME with their FedWatch Tool saying, there's nothing on 50. There's no weight. This week, on Wednesday, we get the minutes of the last meeting. Now that will be interesting because after the meeting on Friday, both dissenters put out a statement defending their position. And no one really much has talked about it since. So there's going to be something in the minutes. I'm sure there's going to be something in the minutes, so that'll make for good reading. I bet you never thought you'd hear that sentence, right? The Fed minutes should make for good reading. CAD CPI in 2 days. I don't think that we would show the same pattern as the U.S. because, well, we don't really have those kind of tariffs. We do have some reciprocal tariffs, but not enough, I think, to really make the same impact that we have. We also get the PPI from Canada this week as well. We only have one auction this week. It's the 20-year on Wednesday. It's not an important tenor. However, a bad or a perceived bad 20-year auction several months back sent the bond market into a little bit of a hissy fit on the long end of the curve. Does it have the opportunity to do that again? And it's just not an important tenor. Here it is right here. You can see the kink over here. You have the 10-year, and then you have a steep increase to the 20, and then flat from the 20 to the 30. This is what really matters. Lots of reason for the 10, lots of reason for the 30. The 20 is kind of an awkward tenor. Too much duration if you are hedging with a 10-year. And if you are looking for duration, grab a 30-year. So it is just an odd tenor. Tuesday, Bowman. We have Jackson Hole this week, so it's odd that we'd have some Fed speak this week. You'd think they'd all be busy. Wednesday, Waller and Bostic. Friday, the big one, Powell at 10 a.m. What's he gonna say? What's the topic? Every year there's a different topic, and when I saw the topic, I thought, okay, let's hear what some of the participants at this symposium have to say about this topic. Let me just get my perplexity screen here. Where are we? Perplexity. I won't put it on the screen. I'll just read it because I said, what is the theme of this year's Jackson Hole Symposium? The theme, labor markets in transition, demographics, productivity, and macroeconomic policy. Demographics, macroeconomic policy, okay. Productivity, great. This theme centers on how changes in workforce size and composition, who cares, technological innovation, and shifting productivity trends are influencing central banks' approach to broader policy. There's AI. It'll be dominated with AI. So both the big business news outlets will be there, Bloomberg and CNBC. I would look probably for a large discussion on the effects of AI on productivity. Anecdotally, you hear it everywhere, whether it's employees, whether it's managers, whether it's business owners that are looking at AI or are using AI. One thing I know for sure is AI is here and it's real and it does work better than an average employee. It does work. So it's not something that we say, this AI, we really should keep our eye out for this, and what effects it's going to have. No, it's here, it's real, it's now. And the now version that we're using is going to be the worst version that we'll be using on a going forward basis, because it'll only get better. Maybe incrementally better, but for some business applications, incrementally better translates to a lot. GPT-5 for me, for some of the things I do, is better than 4.5 by the degrees that are enough that are needed. Because if I've got to fix 20% of the output, and now I only have to fix 16% of the output, you might think, well, okay, 80% right to 84% right, big deal. But if I'm living in the 20% that I have to fix, and you say now that's only 16%, that's a 20% reduction in the amount of work that I have to do. Right away, it's a 20% reduction. So in a business application, those little percentages end up mattering because I do that work. I finish it off. I fix that. So if I got to fix it 20% less, yes, it is incrementally better than 4.5. I really started to embrace most of the AI tools back in early to mid-April. If you listen to the market outlooks, it was about that time where I said, have you revisited these AI models lately? Last year, April, I was, okay, this is something. There is something here, but I still couldn't get it to do some of the things I wanted. But as the models kept coming out, and Gemini adds to its model every month, it added some interesting things I'll talk about in a second. But now, just from April to now, the introduction of some of the new models, Kimi K2, if you ever tried that, that thing is killer, especially if you give it boundaries and you let it work within boundaries, it's killer. So take your OpenAI output, give that output to Kimi K2 and say, expand on this and stand back. It is absolutely impressive. What's it going to be in a year? I mean, I don't know. So what Gemini did is they introduced a tutor to not be at a disadvantage to ChatGPT-5's tutor. You can give it a chapter in a textbook, and it will teach you just that chapter. It will not go outside of that. So we know it's not making up anything. If there's a mistake in the chapter, it'll teach you the mistake in the chapter. That's the only thing you have to worry about is, well, what if the chapter is wrong? So for some readings and some books, some are known to have lots of errors. So if you're at level 3 in fixed income and you give it the readings, it will teach you all the mistakes that are in those readings. You would have to go through that reading and type in all the corrections. But that aside, it'll teach you that. And then what it will do at certain intervals is it will throw out an interactive quiz where the question that they give you, and they're not difficult questions, but they're written to where you happen to be. There is no question bank that can get that done, that can write questions on the spot where you are at that time. So take all of these standardized test prep companies, GMAT, MCAT, LSAT, SAT, they're dead. I don't see any reason for those companies to exist more than another year and a half as they wind down, as their sales start taking a hit, and I'm sure it's already taken a hit. Because for those are standardized. It is hard to see how you can survive above the LLM when all I need as a learner preparing for the test is what the LLM provides me. The GMAT in no way prepares me for a career. In no way. None of these standardized tests prepare you for a career. They are testing your aptitude, period. Now, if we go over to things like CAIA, FRM, CFA, that's different. Those are not standardized tests. And they're not testing your aptitude. The test, in the end, tests whether or not you understood the material. But while you're going through, you are preparing for a career. That is fundamentally different than a GMAT, which does not prepare you for any career whatsoever. It simply just tests your aptitude. Those are dead. Whether a provider that has CFA, FRM, CAIA, Whether or not they continue to exist comes down to two input variables. The first input variable is how many people will avoid a particular profession because AI is just going to take it over. Accounting, I think, is an obvious one because it's I wouldn't quite say rules-based, but it is as rules-based as you can get, way more than finance. Analysis, I think you're going to need fewer analysts, not no analysts. I think organizational size is going to be much smaller going forward. I think the return on expertise is going to be incredible. I know, I'm taking quite a tangent. I haven't finished my screen, but we're on the idea of this symposium and AI and productivity. These are the themes I think will be coming out in this symposium. I'm going to give you a couple of forecasts for 2030, and we'll see whether or not they're correct. Oh, I'll still be here in 2030, don't worry. I think the average size of the organization will be some 10 to 15% smaller than it is now for the same output. So what you would do is whatever level of output they're outputting in 2030, you normalize it for 2025, and then you normalize the size of their workforce. Their sales may increase at this, but the size of the workforce may increase at that. In other words, at that point in time, they would be 10 to 15% smaller than they otherwise would have been. So I think you're going to see that. You're going to see expertise, the return on expertise. It would not surprise me at all if salaries doubled. That if you are an expert in an organization making $220 a year, you're one of the top 20% performers, you're indispensable, turn that to $440 to keep you, because there's going to be a talent war for expertise. Because there are very few experts. The 80-20 principle is very much alive in organizations. 20% of the employees pretty much produce 80% of the output. So I would look for that to double. I would look for the number of entry-level positions to be cut significantly, because if the average size of the organization is smaller, I don't have to onboard 50 people every year so that I can 10 or 15 years down the road fill 10 management positions. Maybe there'll only be 8 management positions and I only have to onboard 35 people a year, and I'll be able to pick from the best, because that wage will be driven down by oversupply. Now let's get to the education industry. Test prep, I think, is going to go fully to ChatGPT, Gemini. The AIs will run it completely. The higher education, what we're doing right now is we're shoving some 45 to 50% of high school graduates into the higher education system. Not the trade schools. Well, I'm talking about the universities, degree granting universities. That's way too much. So I think, and you have the last count, there was over 3,000 education institutions in the U.S. I think the university level, that is going to shrink a lot. I think a lot of universities are going to have real existential crises. You're going to see waves of universities over the next few years just going away, because you got to get that 40 to 45%, 40 to 50% of the high school graduates you're shoving into the university system, probably down under 20%. I know that sounds rough. The estimate 40, 50, 60, well, more like 60, 70 years ago was that only about 15% of the population had the capacity for university education. Now we're up to 50%. So I think that falls to under 20%. This is the topic of the conference that they're having, and I'm hoping that then begins to settle into these central bankers saying, there's stuff going on today, but this stuff in the future, this is going to be pretty bad. Now combine this wave of productivity that's going to happen. Productivity means fewer people. That's what it means. Higher output for the same people, or the same output with fewer people. Combine that with just the sheer almost inaffordability of the national debt at these interest rates. Maybe you scare them into 50 basis points. Maybe there's somebody that says let's go 50, but I'm pretty sure the weight on a cut is going to be 100% coming out of that. Let's see what Powell has to say at 10 o'clock, and let's see what the participants throughout the week have to say about the topic, and hopefully the interviewers do ask about the topic, but I think AI will dominate. All right, let's look at the other big deal that's happening, and this will be interesting because the question of what happens next is unknown. Look at reverse repo. It's almost zero. It is now 37.75 billion. The lowest in this round, at least, was August at 28.8 billion. It always ticks up into a weekend, and into an end of a month, it ticks up again. This is worth watching because next week it has the very real possibility of hitting zero. Now, when that hits zero, what happens next? Reserves start coming down. This is sort of like the swing variable for the reserves. This is the canary in the coal mine. Once that hits zero, you're going to start to see this number come down. Why is that a big deal? The Fed operates under a regime called ample reserves. And if you have ample reserves, the reserves should be insensitive to any changes in policy that you do, such that you do not have to conduct any open market operations to target your rates. If you say it's between 4.25 and 4.5, the ample reserves regime should take care of that. But what is ample? How much is ample? No one really knows. My guess, last time they ran into trouble, reserves were sitting around 1.8, 1.9 trillion. That was in 2000, was it 18, 19? But that's the last time they ran into trouble. Then they had to open up the repo channel, and they started buying more securities at that point. The my guess is around 2.5 trillion. So as soon as this hits zero and this starts moving down, once you get to 2.5, you're going to be canceling balance sheet runoff, and you might even have to step in to the market because you don't quite know where it is. That's going to be interesting. TGA sitting at 515. Besson's target is 850 on this, so this will probably continue to increase till it hits 850. Let's look at our week over week TLT down 1%. I've sold 86 puts and 87 calls on the position that I have, so I've collared it. So above 87, it gets called away. Below 86, I get more of them. I'm in a position to take more at these low prices. If it gets called away at 87, I think I got two something for it. Let's call it 240, somewhere 240, 260 for this strangle. So that would give me an exit around 89 and change. On any big rally in U.S. bonds and TLT, I would probably look at that as my exit, because long term I just do not feel good about the U.S. longer term. Well, when I say long term, Trump term. Well, long term maybe, but Trump term I don't feel too good about it. Fed Fund Futures, Q3, almost a basis point cut, 22.5, which is why we still have the 15 over here. It's being picked up. If it was 0% on the 0 and 100% on 25, this would be 25 basis points. Q4, 33.5, so still sitting at the SEP projection of 2, slightly over 2 cuts this year. I don't see a double in September. I see a single. I see 25 basis points, but you still have 2 more meetings. So maybe you get 3 cuts. If you got 2 cuts, that would put the January ZQ at 96.17. It's 96.23, so if you buy at 96.23, you are betting on 3, because if there's only 2, you're going to lose 6 basis points on each contract at 41.67. That's some $250 you're agreeing to lose. So it's a $250 bet that pays a lot more than $250. $250 to the downside. If there is a cut, it goes to 96.42. Right, 96.42, which is 19 basis points to the upside. So you get 19 times 41.67, but it's going to cost you 6 times 41.47. So it's sort of a 1 to 4 payoff. You're betting $1 to make $4 on this one. 3, I don't know that I'd be too willing to take that bet until I hear what Powell has to say at the end of this week. But if he signals that, yes, we should be heading lower in rates, these EQs will reset very quickly. There'll be no getting in, so you are making the bet. It's too near term for me to make that bet. Q1, pricing in almost another basis points. Q2, almost another rate cut. And Q2, almost another rate cut. Total 99.5. Firmly 4 rate cuts in 7 meetings. I think the play here is not the May. I think the play is the October 2026. We're at 96.84, implied rate of 316. That's 117 basis points. That's 4.5 cuts in 9 meetings. Once you get out of May, you're going to have another governor. And if it's Waller, his position will be replaced with another loyalist. Loyal not to the Constitution, not to the mandate, but loyal to Trump. And who knows who's going to quit or resign in the interim because they want to have nothing to do with this. And besides, honestly, they don't get paid enough for this. Powell gets $180 a year, $180,000. You'd think a position that powerful would pay more. $180 a year. You do it for public service. You're certainly not doing it to get rich. So I think the play is there in October of 2026. My first bid is at 96.80. I see this at 96.80. I'm going to grab 2. And every 2 basis points down, I'm going to increase. So if it goes to 96.78, I will then add 4. If it goes to 96.76, I will then add 6. Not bring my position to 6, add a full 6 more contracts. Because I do think that that one has the likelihood to be 200 basis points lower, not just 117. I think that's 4 is probably an easy bet to make. This is 4.5. I think it's an easy bet to make. You're going to get that. I think my downside here would be almost nothing. In fact, probably my downside would be a small gain. That would be my downside. My upside would be quite large. So I don't mind going into this with maybe even up to 100 contracts on that one. Okay, let's look at real yields and housing. Okay, our real yields have all crept up. This here, that's interesting, right? The break-evens have not changed week over week. Maybe the bond market is trying to say, look, this is transitory. We're going to look past it. Once it's over, we'll see it's not there. And off we go. But our real yields are doing all the heavy lifting from our nominal yields. Corporate spreads. I saw a headline, I think on Bloomberg, or was it from Wall Street Journal, that corporate spreads are the lowest they've been in, I think it was like 47 years. Right, look at IG, 77 basis points. High yield index, 289 on that. Even triple B, under 197. Triple C, trying to print a 7 handle. Doesn't even want the 10s, the 9s, doesn't even like the 8s. No, I want a 7. All of them are lower. Well, not all of them, sorry, but they're the thing that I've been saying every week. Nothing to see here. So there's nothing to see there. Look at the 30-year fixed rate mortgage printing a 6.5 on this one. 6.58 down another 5 basis points. We have a busy week in the housing market coming up. Monday, you get the housing market index. It's a diffusion index for August. Previous reading was 33. Anything under 50 is contraction. It's been in contraction for some time. This is for the housing market. Let's see if we can come in above 33 with the fixed rate mortgage coming down. Foot traffic has to be increasing, although we are going into the slower season for real estate. So you're getting lower rates coinciding with a natural drop in foot traffic as you get into September, October, November. These are the deepest months in the housing market in terms of the lowest in foot traffic. really starts to pick up in the spring, late February, March, April, it really starts to pick up. The traffic, foot traffic starts to pick up. But the 6.5's got to be bringing in some foot traffic. Tuesday, we get housing starts for the month of July, and building permits, preliminary. You get this twice a month. You get a preliminary and you get a final. We get a preliminary for July. And Thursday, existing home sales. Let's have a look at how our home builders have been doing this year. Not bad overall. DHI is at 165.62 year to date. That's up 20% just in the last 3 months. Because if you look at their charts, they kind of did this in the last 3 months. They've done this. I mean, they've really accelerated. Up 36% in the last 3 months. Lennar up 22.29 in the last 3 months, 6% for the year, sitting at 131. DHI, I think, is the better of the two home builders. Toll Brothers, higher end pricing, higher end housing. 130.50, up 4.29, but beating out Lennar for the last 3 months, up almost 25%. Pulte, up 18.68. For the year, very close to DHI, up 26% in the last 3 months. DHI still the winner on this one. KB Homes for the year, down for the year, but up 17.14 in the last 3 months. Going to our mortgage REITs, agency up 14% this year. That's something, right? Up 11.74 in the last 3 months. Annually up 22%. If you just look at the last 3 months, up 10.65. And ABR for the year down 8.43, but look at the last 3 months, 13.32. All of these do really well. All of these, look for them to do really well when that 10-year drops below 4%. You get that 10-year down under 4%, I'd say this is probably where you'd first want to be, is in here. I think you have a lot of upside potential, latent upside potential in there. Home builders seem to be anticipating the rate cuts, and it was fairly good earnings. And anticipating the rate cuts, we're going to see when we get the small caps. Small caps are really anticipating the rate cuts. So I don't know how much more upside there is, but they tend, I don't know that I would say, oh, they're overvalued, and let's start shorting them into a rate cutting cycle as this 30-year keeps coming down. I'd be very cautious there. I'd be cautious here. I'd be more likely to hang out over here because they probably have the best potential. They probably have the greatest sensitivity to interest rates. If you look at their balance sheet, they have assets and they have liabilities. The liability side uses repos. So as the short rate comes down, their liability cost immediately comes down. If the long end of the curve doesn't move, well, then their asset value really doesn't increase that much because the spot rate curve derived from the par rate curve probably wouldn't change very much if the long end of the curve does nothing. So if you get rate cuts from a curve that looks like this, and all you get is a curve that looks like this, this is just steepening from the 2 to the 10, which I would bet on. I think you get a curve steepener over the next year. This will help the liability side. This will lower their cost of financing while not changing their asset value. But if you get lower rates over here and you get a curve also with lower values over here, not only do you get lower liabilities, but you get higher asset values at the same time because that pulls the whole spot curve down. I'd be more likely to sit here because I would, if nothing changes on the long end, I immediately get lower interest costs on the liability side. That all of that goes right to net income. All of it goes right to net income. Okay, let's have a look at SPY. Hit an all-time high. Been saying this for 2.5 years now. Hit an all-time high, August 14th, 654.16. And so did QQQ. Hit another all-time high, August 14th. And we're on Google Watch, very close to hitting an all-time high. Forward 4-quarter operating earnings 282. We ended at 64.49 on the index. Puts us at 22.8 times the forward earnings, up from 22.62 last week. Implied volatility back a little bit. On Thursday, it was basically zero. well, I shouldn't say basically, it was 0, and for Friday, for Wednesday it was 0. For Thursday and Friday, we end with 5% on the 13-week. Small caps really having a week. Look at IWM. And IWM intraday was over 230. And IJR intraday was, I think I saw a 116 on there, but it definitely was in the 115s. And pulled back to the 114, 227. Still up 3% for the week. Intraday, when it was over 230, this is about 4.5% for the week. That's one hell of a week on small caps, 3%. IJR up 3.2% versus large cap tech primarily up 0.49. And we've already seen the week over week for SPY wasn't really that stellar. I think it was less than 1% up. So a beta this week of 3, a beta of 6 compared to QQQ. So finally our small caps are coming along. You get a rate cut in September, and you get a signal that we're on a rate cutting cycle, and it's not just a one-off. Look for these highs to be taken out and the small caps to start printing all-time highs. But the most recent highs for IWM, 241.98, sitting at 227. It's still $14 higher, which is some 12 to 14% higher. Same with IJR. Google ended at 205.10. All-time high February 3rd was 205.22. But intraday, ID sub H, intraday high was 207.33. So I thought, well, that was probably your all-time high. But on February 4th, we hit a high of 205.22 on February 3rd. February 4th, it spiked and then came right back down and closed below February 3rd. You hit an all-time intraday high of 211.17. On a closing basis, Google is very close to printing an all-time high. On an intraday basis, we're still a little ways away. I'd made the case that I think 225 to 230 is a near-term target for Google. It still has its own set of problems, but it does have a level of momentum behind it based on its last earnings, indicating search is up. That's a big thing to lose. Search is up. I'm not sure how that works out in the long term, because I now use Perplexity unless Google has a compelling reason to bring me back. I just use Perplexity, and I think more and more are doing that. And I don't get any ads, and I don't got to click on blue URLs. So that's a big problem to solve. And it does have an antitrust case in front of it. That's a big problem that has to be solved. And that's why it's trading for a multiple lower than the market. That's why it's not trading for 30 or 35 times forward earnings on its AI story. AI is basically not even being priced in. Well, let's just say that AI is being priced in, but being dragged down significantly by these other two factors, so that it would trade up to the multiple of the market. To me, would say that's still pricing in all the risk, because if you didn't have those two issues, big issues, mind you, if you didn't have them, you'd probably be at 30, maybe even 35 times earnings, with the likes of Meta hitting just straight up hitting all-time highs every day, every week, and then the next day opening up another $8, $9 higher every day. Google would be participating in that, but it's not, because of this. If they can solve this search issue, if they can solve it and say, here's our solution, we've got it, that's a big deal. And if they can get past this antitrust, that's another big deal as well. But yeah, don't be lulled into thinking that it's massively undervalued, because it has two very big risk factors. But I think it could, in the near term, trade up to the market multiple at least, which is 225 to 230. This week we have 16 companies reporting. They both agree. They just disagree on the dates on which these companies are reporting. I'm asking too much. I'm asking too much that they both have the same verifiably objective information. It's a step too far. Tuesday, Palo Alto. If you're in the cybersecurity space, CrowdStrike is the largest in terms of cloud, and Palo Alto has both cloud and physical firewalls. And Home Depot. Wednesday, Estee Lauder. I include that in there because their price has been on fire this year. Target and Lowe's, along with TJX. Next day, Walmart. You're getting all the big retailers. Friday, Ross Stores. Target, Target has its own problems. So when Target says something, you have to think, well, is that a reflection of the broad shopper, the consumer, or is that a reflection of Target? Walmart is the better reflection, I think, of the strength or weakness of the consumer. Not only that, if you're going to have a tariff impact, Walmart probably is, at the consumer level, is ground central for that. So let's see what they have to say. And then Friday we have Ross Stores. Let's have a look at Deere. CAT reported 2 weeks ago, not so great. Deere reported, and not so great. But in both of them, they talk about the tariffs and what they expect for the tariffs and the effect that it is having. The guidance for Deere is not good at all. Okay, for Deere, we'll just use their earnings call presentation. I did do the 20 points infographics for this, which will be up on Monday. Taken mostly from here and from their conference call, but I think we can get a lot from here without going into those. Let's just look at Q3 2025 results. This is in revenues. Some numbers they report are in units. This is in revenues. Net sales year over year down 9%. The net sales and revenues. Net sales, this is just equipment operations. You're taking out financing. Financing is sort of the bright spot in there. Taking out financing, down 9%. Net income down 26%. That's called leverage, operating leverage. Beautiful on the way up. Painful on the way down. Diluted EPS down 24%. Year over year down 26%. It's a big number. They have three categories. Production and precision ag, then they have small ag and turf, and then they have logging and construction. This is their biggest, is production and precision ag. This is all the big farm equipment. It's their biggest market, so here is the most important one. Down 16%. This is in millions. Later on, we're going to see their forecast in units, but this is in millions. Down 16% year over year. And we can see where this is last year, and then you have this nice little step chart, which tells you the effect that every one of these categories happens to have. Production costs, they were able to squeak out some gains in production costs, but here you go, look at that. That is volume and mix. So if you have 10 units, 10 different things that you sell, some of them will be a higher ticket, higher margin items, some will be lower ticket, lower margin items. If you're selling less of them and your mix shifts down to the lower priced ones, you take a double hit on your margins because your volumes are down and it's negative from mix as well. 494 million hit from volume and mix. That's pretty much everything in there. Small ag and turf, only down 1%. What is this? You ever see those weekend jockeys on their riding lawnmower with a beer in one hand, cutting their lawn with their little lawn with their $12,000 tractor? Because you got to have that $12,000 tractor, and then you got to have the other people, the other middle-aged men in the neighborhood gather around it when he's done and talk about it. You ever see that? Anyways, down only 1%. Savings on warranty costs. You make things better, you can actually save money. You can actually do quite well. Some savings in production costs here. Price, you can see the volume mix, not much. Price is just, I'll increase my price. And there's the outlook in units. Largest segment, look at US and Canada for large ag units. They expect for full year 2025 to be down 30% from last year, from 2024. In units, 30%, that's huge. For small ag and turf, this is large ag over here. This is ag and turf, so it's combining the two together. US and Canada, large ag down 30%, US and Canada, small ag and turf down 10% in units. Europe flat to down 5%, South America sideways, flat. And Asia, flat to up 5%. Where's our problem here? North America. And here we have the outlook net sales. You see down, they're expecting it down 15 to 20%. You say, well, hang on a second. They expected volumes to be down a lot more. That's volumes, this is sales. So that combines, pricing and mix. This little line part up here is the range. The 15 to 20% down. So the top of it is down 15%. The bottom of the olive green is down 20%. Net sales down 20%. Operating margins 15.5 to 17%. This is margins versus 21.7%. You would get margin compression. Small ag and turf net sales down 10%. Operating margins from 14.8 to 12 to 13.5. You can see that this is far more important, as the production precision ag has much higher gross margins. Construction and forestry was down 5% year over year for the quarter. Volume mix did all right, but couldn't really increase their prices. Have to get aggressive and lower their prices. Warranties, they're not a little bit hit on quality here. Higher warranty costs and production costs, costing more to make this stuff. Here is the outlook, US and Canada. This is in units now, down 10%. US and Canada, compact construction equipment. If you ever have a contractor come to your house who's redoing your driveway, he's got one of those little bobcats and maybe a little backhoe, that's what that stuff is. Flat to down 5%. Global forestry, flat to down 5%. And global road building, flat. Again, look at US and Canada over here, down 10% on construction equipment. That's their big margin stuff in that category. This is their outlook, net sales down 10 to 15%. Operating margin from 15.5. Look at the hit over here, 15.5 to 8.5 to 10. There's nothing good in this report. Financial services, I shouldn't say there's nothing good. Here you go, financial services. Quarter results, 205 versus 153. Too small, but it's there, right? 205. Fiscal year outlook, still forecasting that it's going to be higher than last year. So here's their company outlook: net income 4.75 to 5.25, effective tax rate 19 to 21%. This is not entirely true, the 19 to 21%. Let me tell you why. Let me grab the infographics that I do have, and let's look at the tariff impact over here. Tariff costs in Q3 reached approximately $200 million, bringing year-to-date tariff expense roughly to $300. They expect 2025, which has one quarter left, to hit $600 million. So there's still another $300 million that they need to take in. So when they say their effective tax rate is 19 to 21%, these tariffs are a tax. You'd have to say, well, how much tax did you pay? And let's throw on this other $300 million, or the $200 million you had for the quarter. Well, this is fiscal 2025. Throw on the $600 million onto all the taxes. Now what's your effective tax rate? Because the tariff is a tax. So that effective tax rate, if you're going to model this going forward, say, well, how do we model the effective tariffs and the effective tax rate? I would say whatever they're forecasting for their hit to tariffs, I would model that as part of their effective tax rate to see where it really is, because it is a tax. Net operating cash flow 4.5 to 5.5. One thing we can say about Deere that is positive here is they've got a fortress balance sheet. Research and development expense, they're forecasting to be down slightly. CapEx, roughly about $1.4 billion. And their shares took a dump. And CAT, even after CAT dropped on their earnings, and then kind of was like, yeah, you know, is it warranted? And then when Deere reported, CAT took a step down as well. So I don't know that I would look to too much excitement in that category, and I'm not sure lower rates are going to help them. It is the tariffs that are killing them in their bottom line. $300 million off the bottom line. Those tariffs are showing up. It's being imported into their cost of materials, so their margins are being hit. So the taxes are showing up in their margins. If you pull the tariff out and dropped it to the bottom line, I think the margins would be okay. Maybe some basis points down on the margin because of shifts in mix. The margins would be okay. And shove it all the way down to the effective tax rate, I think that would be a better representation of the operations. However, when you order in, if your steel is coming in from outside of the country, if your copper wiring is coming in from outside the country, you're paying for it, which means you have higher cost of goods sold. You're going to have margin compression, but let's be realistic. It is a tax being smuggled into cost of goods sold. When we do, in 3 years from now, when analysts are doing a 5-year historical look at these companies, they're going to have to, for the analysts out there, you know this, they're going to have to make an adjustment for the margins, because they'll see margins at one level and then boom, it drops to another level. It would be the same thing as saying, okay, some of your income tax, let's call it a cost of goods sold. Let's throw it into cost of goods sold. You'd have a hit to margins right away. I seem to think, because these tariffs, as I said, to get it cleaner. If it were me and I had to fix 5 years, I would be looking in the notes for how much of that was a tariff hit, and I would adjust cost of goods sold by increasing it by the tariff hit, and also increasing the taxes by the tariff hit, so I had a better estimate of what the effective tax rate was and a better estimate of what my production costs are and what my gross margins are, because this tariff is out of my control. That is not a reflection of my internal efficiency decreasing. As an analyst, in 3 years, you're going to have to pull that apart. Anyways, I thought it was interesting going through this. Let's leave it here, and I will see you next week.